The Deregulation Bogeyman by Tom Woods. This audiobook was assembled for your convenience by Libernaut. You can support this production and productions like it by visiting Libernaut.com. Be sure to subscribe to The Tom Woods Show, available on iTunes and Stitcher. You can download this free ebook at regulationmyths.com. In addition, you can find information about Tom's Liberty Classroom, the Ron Paul Homeschool Curriculum, the Contra Krugman Podcast, and other projects from Tom Woods at tomwoods.com. The Deregulation Bogeyman by Tom Woods. The Wrong Lesson. In 2009, I published Meltdown, which was essentially the first book on the financial crisis to be published by anyone. I wrote it because I could already see the conventional wisdom beginning to ossify. Why, the economy blew up in 2008 because of capitalism run amok. This is as wrong can be, yet it has reached the status of something, quote, everyone knows. The 2008 crisis has passed into history, but it remains important for us to study and understand. As F.A. Hayek observed, if we don't get history right, then we'll get the present dreadfully wrong. In Meltdown, I placed a great deal of emphasis on the role of the Federal Reserve System in causing the housing bubble and the subsequent bust. This book, which is focused on the more specific question of whether deregulation caused the crisis, spends less time on the Fed. So, for that aspect of the question, I refer the reader to Meltdown. Now, on to the myth-busting. Tom Woods, October 2018. Chapter 1. The Deregulation Myth. For some people, the argument seems so natural that no real research is necessary. They just know deregulation must have caused our problems, even if they have no idea what deregulation is, what it consisted of, or what exactly our problems are. Countless Americans have permitted themselves to believe that there is no serious problem their wise overlords could not have prevented had they been able to crack a few more skulls. The possibility that our protectors may themselves be the source of the problem is unthinkable. A review of the key planks of financial regulation over the past several decades reveals little that could account for the severity of the crisis that struck in 2008. First, Regulation Q, which limited the amount of interest banks could pay on savings deposits, was mostly repealed under Jimmy Carter. That move seems unlikely to cause a global financial meltdown 30 years later. Next, the Regal-Neal Interstate Banking and Branching Efficiency Act of 1994 repealed restrictions on interstate branch banking. Far from destabilizing the banking system, that repeal presumably strengthened it by making portfolio diversification easier. And finally, bank holding companies were allowed to underwrite corporate securities. That in itself is not particularly risky, and Columbia Business School's Charles Calamoris is right to note that we would be in much better shape today had these institutions been doing more corporate underwriting, similar to insurance, and less securitizing of bad mortgages. There is nothing relevant that the banks did in the years leading up to the crisis that they could not have done in the absence of deregulation. Banks have always been free to hold or securitize mortgages, including the subprime and no-doc varieties. There is no repealed regulation that would have prevented them from doing these things. The one specific act of deregulation that is sometimes pointed to as a contributor to the crisis is the partial repeal of the 1933 Glass-Steagall Act by means of the Gramm-Leach-Bliley Act in 1999. We heard less about it once proponents of this theory realized that future Vice President Joe Biden had supported it while in the Senate and Bill Clinton had signed it into law. The Glass-Steagall Act of 1933 consisted of 4 basic provisions that combined to erect a wall between commercial and investment banking. First, it prohibited banks from underwriting or dealing in securities apart from essentially riskless government-issued or government-backed securities. The prohibition on dealing in securities meant that banks could not acquire securities for the purpose of selling them, but they could acquire them to hold because they believed them to be good investments. Banks could later sell them when they concluded they were no longer good investments or when they simply needed cash. Second, securities firms could not take deposits. The remaining two provisions prevented banks from even being affiliated with firms whose main function was to underwrite or deal in securities. Graham Leach Bliley repealed only this last part of the earlier legislation, thereby making it possible for a commercial bank and an investment bank to coexist under the umbrella of a common holding company. It did not repeal the provision preventing banks from underwriting or dealing in securities. Commercial banks continue to operate under the same Glass-Steagall restrictions that have existed since 1933. The financial condition of the banks and the financial crisis itself had nothing to do with the repeal of Glass-Steagall. The problem occurred because banks made bad loans and investments. In other words, banks did a poor job at traditional banking activities, not some newfangled activity that deregulation had made possible. Many commercial banks held large portfolios of mortgage-backed securities, but it wasn't some repeal of Glass-Steagall that allowed them to accumulate those portfolios. They were always allowed to do so. But did the repeal of two provisions of Glass-Steagall allowing affiliation of commercial banks with securities firms through their control by the same holding company contribute to the losses and risk that permeated the system? Certainly not. For one thing, commercial banks bought mortgage-backed securities for their AAA rating, their attractive return, and the minimal capital requirements associated with holding them. They did not acquire these assets because they were connected to investment banks that were trying to unload them. Moreover, severe regulatory firewalls essentially prevented this kind of affiliation from contributing to losses or increased risk on the part of the commercial bank involved. The reverse problem, that affiliation with a commercial bank might bring down an investment bank, is exceedingly unlikely, given the relative magnitudes of assets held by each institution. The commercial bank's assets were only a tiny fraction of those held by the investment banks they were affiliated with. These banks were in no position to cause the investment banks any serious problem, much less their complete downfall. Meanwhile, the record of the Federal Reserve, the chief regulator of the banking system, was less than impressive. During the boom years, the Federal Reserve boasted of its unique ability to foresee and prevent financial crises. In January 2007, on the verge of the crisis, Federal Reserve Chairman Ben Bernanke told a gathering of academics, "Together with the knowledge obtained through its monetary policy and payments activities, information gained through its supervisory activities gives the Fed an exceptionally broad and deep understanding of developments in financial markets and financial institutions." In my view, however, the greatest external benefits of the Fed's supervisory activities are those related to the institution's role in preventing and managing financial crises. In other words, the Fed can prevent most crises and manage the ones that do occur. Finally, the wide scope of the Fed's activities in financial markets, including not only bank supervision and its roles in the payment system, but also the interaction with primary dealers and the monitoring of capital markets associated with the making of monetary policy, has given the Fed a uniquely broad expertise in evaluating and responding to emerging financial strains. Later that year, the housing bubble burst. Of course, the Fed failed to prevent the current crisis, and, as I argued in Meltdown, itself bears much responsibility for what went wrong. Did that make the political class re-examine the Fed's claims about its wondrous abilities? To the contrary, in the wake of the crisis, the Fed was given still more regulatory authority. It seems to be a general rule. No matter how badly regulators fail, every crisis brings calls to empower them further. There appears to be nothing regulators could do to make the public consider the excluded possibility that mere regulation of a flawed system doesn't make the system at root any less flawed. Our talking heads who thoughtlessly call for more regulation as a panacea are attributing quasi-magical powers to people who in the real world tend to be unworthy of these exaggerations. As Robert Higgs puts it, Had they been given even greater powers, budgets, and staffs, what enchantment would have transformed the regulators into smart, dogged champions of the public interest, rather than time-serving drones and co-conspirators with the regulated firms that they have always been? The case of Bernie Madoff comes readily to mind. Madoff ran a scheme in which wealthy, if gullible, individual and institutional investors wound up losing $50 billion. Madoff, his clients thought, was extraordinarily skilled at beating the market. In fact, all he was doing was taking later clients' money and using it to pay earlier clients, a scheme that required the addition of a greater and greater number of new clients over time, the definition of a Ponzi scheme. The immediate and predictable response ran as follows. The Madoff fiasco shows what happens when you cut funding and personnel for the Securities and Exchange Commission, SEC, which, critics said, suffered under George W. Bush. Additional regulators and more funding would solve the problem. Back on planet Earth, George W. Bush hadn't cut funding or personnel for anything at all. SEC funding increased at an 11.3% annualized rate as compared to 6.8% under Bill Clinton, and its staff grew at 1% per year as compared with negative 1.2% under Jimmy Carter. So we have to entertain another theory. Perhaps, for all its employees and wealth, the government had simply failed. The SEC had been warned about Madoff for at least 10 years, and perhaps as many as 16. Madoff even boasted of his family ties at the SEC. Even though it had the largest budget and largest staff in its history, it still failed to act. By contrast, Harry Markopolos, one of Madoff's competitors, simply examined the option strategy Madoff told his clients he was using and concluded that his alleged results had to be fraudulent. An alert competitor has a powerful incentive to be a good regulator. Well, it may have taken them at least a decade of warnings, but at least the SEC finally wised up and nabbed him, right? Actually, the SEC had nothing to do with it. Madoff's own sons turned him in after he came to them and explained what he had done, and he felt compelled to approach them with the real story in the first place only because his financial situation had begun to deteriorate so badly. Catching him had nothing to do with the SEC at all. The very existence of the SEC lowers investors' natural alertness. For example, if such and such investment outlet were in fact a criminal Ponzi scheme, people assume the SEC would have done something about it. A private certification agency that made an error of this magnitude would be finished, never to be heard from again. Would you, dear reader, continue to rely on it? Meanwhile, other institutions would quickly gain market share at the incompetent firm's expense. The SEC, on the other hand, is going to get more money. As it turns out, spending and personnel have increased dramatically, not just on the SEC, but throughout the whole arena of financial regulation. The 12,190 people in Washington, D.C. alone who are charged with overseeing American financial markets would probably have something to say about the, quote, unregulated American financial system. Adjusted for inflation, spending on the regulatory agencies in charge has tripled since deregulation began in 1980. Boston University economist Lawrence Kotlikoff came up with a tally of 115 regulatory agencies for financial services. Are we supposed to believe things would improve with 116? But the presence of more regulators doesn't need to translate into more genuine oversight. According to Nobel laureate George Stigler's capture theory of regulation, firms in a regulated industry tend to capture the regulatory body, such that they and their concerns dominate the regulatory agenda, and that agenda becomes an instrument of the further aggrandizement, rather than the genuine supervision, of the industry. If Stigler's correct, then we have here another reason to consider it simplistic, even childish, to foist major tasks of economic stabilization onto regulatory bodies in the superstitious hope that this race of supermen will identify and act upon problems before anyone else perceives them, and always with an eye to the public interest. At a Federal Reserve conference in 2008, economist Willem Buter spoke of cognitive capture, a phenomenon in which regulators eventually become incapable of thinking about the relevant issues except in the way the regulated industry thinks about them. And that is not to mention the revolving door that often exists between the regulatory agencies and the private sector. Quote, SEC lawyer one day, opponent the next, end quote, ran a Wall Street Journal headline in 2010. Observing the traditional common law treatment of fraud and bad dealing would be much more effective than still more layers of rules, which would have results no different from what they have always been. According to Gerald O'Driscoll, a former vice president of the Dallas Fed, quote, the idea that multiplying rules and statutes can protect consumers and investors is surely one of the great intellectual failures of the 20th century. Any static rule will be circumvented or manipulated to evade its application. Regulators failed to identify the growing problems in the U.S. economy that culminated in the crash. To the contrary, we were told things were fine and that the economy was robust. For one thing, regulators made the mistake of relying heavily on the risk assessments of a small cartel of government-approved ratings agencies that were not subject to competition. Beyond that, they either grossly misread the conditions of the housing market or they simply misled the public. Alan Greenspan said in 2005 that conditions in the housing market were actually, quote, encouraging. Ben Bernanke, who became chairman of the Fed the following year, declared that, quote, our examiners tell us that lending standards are generally sound and are not comparable to the standards that contributed to broad problems in the banking industry 2 decades ago. In particular, real estate appraisal practices have improved, end quote. Bernanke admitted that, quote, slower growth in house prices, end quote, may be possible, but then added that he would simply lower interest rates if that were to occur. But suppose regulators had been able to perceive the problem. Would they know how to fix it? Or even have the courage to try? Quote, a regulatory crackdown on loose mortgage underwriting standards in 2004, writes economist Russ Roberts, would have meant taking away a punch bowl filled with more home ownership, particularly among minorities, as well as expansion and profits in the businesses of home building, real estate brokerage, mortgage origination, and Wall Street financial engineering, end quote. Not too likely, in other words. And to put it bluntly, how many business school or other graduate students aspire to become regulators? The brighter students go on to become successful businessmen and entrepreneurs, and the slower ones wind up in the regulatory agencies. We expect a kid who graduated number 505 out of a class of 508 not to get his clock cleaned by a kid who graduated number 12? The Dodd-Frank Financial Regulations Act, the financial reform bill passed in 2010, proposes to solve the problem of financial instability. But perhaps financial instability might have been avoided in the present case had the federal government and the central bank not distorted the housing market in the first place. Not a word in the bill mentions the Fed's role in financial bubbles. Bubbles, once again, are assumed to be spontaneous events that come from nowhere, and against which we need rafts of regulators to focus their watchful eyes. As I argued in Meltdown, in discussions of financial crises, the Federal Reserve is the elephant in the living room everyone pretends not to notice. No one quite knows what the bill's full impact will be. Its text contains over 100 references to, quote, the agency shall set, quote, the agency shall determine, and so on. It will be years before its full significance becomes clear. What we do know is that as of November 2010, financial lobbyists had met with regulators 510 times over the Dodd-Frank Act. The bill's 2,300 pages still leave enormous discretion in the hands of regulatory agencies, and the usual suspects are angling to get things to go their way. Quote, Frank Dodd has created huge power centers at these agencies, writes economist Robert Wenzel, and it is real expensive to get access. Try calling up Federal Deposit Insurance Corporation chairwoman Sheila Bair and see if you can get a meeting with her the way J.P. Morgan's Jamie Dimon did. It is interesting to note, though, how the bill addresses admitted regulatory failures. According to Congressman Barney Frank, the Fed, quote, has a terrible record of consumer protection, end quote. Consumer protection duties are therefore to be transferred to a new regulator. That'll show 'em. Except, no Fed employee previously responsible for consumer protection is actually being fired. They're all being hired by the new regulator. As called for in Section 1064 of the bill, quote, all employees of the Board of Governors identified shall be transferred to the Bureau for Employment, end quote. The bill abolishes the Office of Thrift Supervision, diverting its responsibilities to the Office of the Comptroller of the Currency. That'll show 'em. Except, need we even say it? No one is actually being fired, says Section 322. Quote, all employees of the Office of Thrift Supervision shall be transferred to the Office of the Comptroller of the Currency, end quote, or to the FDIC. By the way, the Office of Thrift Supervision was created as the alleged solution for the economy in the wake of the savings and loan collapse in the 1980s. What's more, the kind of prudential regulation that we are assured will prevent future crises wound up contributing to the present one. The capital requirements under which banks operated rewarded them for holding mortgage-backed securities by permitting them to hold fewer reserves against them, thereby freeing up more money for loans. For every $100 it held in standard loans, a bank needed $10 in capital. For every $100 in mortgage loans, the amount was $5. But for every $100 of AAA-rated mortgage-backed securities they held, banks were required to have only $2 in capital. This advantage naturally encouraged an artificial rush into this particular kind of asset. On a free market, institutions are likely to hold a wide variety of assets. But when government regulation artificially fosters one kind of asset over another, as it did in this case, the favored asset will be more widely held than it would otherwise have been. And if it declines in value, the economic effects will be that much more severe. Regulations, say economists Jeffrey Friedman and Vladimir Krauss, quote, are like mandatory instructions for herd behavior, automatically increasing systemic risk, end quote. To be sure, we encounter much hand-wringing about poor management at major financial institutions. What we do not hear so much about is that the current regulatory environment makes it essentially impossible for professional and institutional investors to do anything about it. Institutions like insurance companies, pension funds, mutual funds, and banks are not permitted to hold more than a very small stake in any particular company. Hedge funds and private equity investors are restricted by regulations that prevent them from acquiring a controlling interest in a bank holding company. But it is these kinds of institutional investors who have a direct stake in the firms in question that are best positioned to keep wayward management in line, hoping that regulators will perceive such problems when they have none of their own money at stake and when, as in the present crisis, they have a track record of identifying problems as virtues holds out much less promise. Because of this government policy, stockholders of these institutions are artificially disorganized and scattered and cannot discipline bank management properly. Management, meanwhile, enjoys an artificial protection that would not exist on the free market. When bank managers feather their nest under such a system, our commentators then react with surprise. Investment bank leverage was too high, say critics. In other words, these institutions were looking to multiply their gains by using money borrowed at low interest rates to purchase long-term assets they expected to increase in value. These institutions may well have engaged in too much of this, but we should pause to consider why they might have done so. Why would equity ratios be so low in the financial industry and so much higher everywhere else? And it is a contagion. Once one firm starts borrowing short-term funds to buy long-term assets, other firms feel compelled to follow suit if they don't want to be left in the dust. Could it be that the financial industry, unlike the shellfish industry or the publishing industry, has a giant sugar daddy in the form of the Federal Reserve standing in the wings to provide liquidity at critical moments with the federal government on, quote, too big to fail, end quote, grounds, standing ready to assist them in case of an especially serious problem? When Alan Greenspan made sure the long-term capital management hedge fund was bailed out in 1998, Wall Street firms naturally concluded that if a hedge fund wasn't allowed to fail, then surely no investment bank would be permitted to go under. Even the International Monetary Fund admitted in an April 2008 report that big financial institutions were taking excessive risks in the expectation that their central bank would bail them out. They have grown, quote, more complacent about their liquidity risk management systems and underinsured against an adverse liquidity event, depending more heavily on central bank intervention for their liquidity problems, end quote. The Fed's interference with short-term interest rates, moreover, and what has been politely called its, quote, overly accommodative, end quote, monetary policy, has much to do with the leverage employed by financial intermediaries. New York Fed President William Dudley observed in 2009 that, quote, there is a growing body of economics literature on this issue that links monetary policy to leverage, end quote. It is the system itself, in other words, that is the problem. According to economist Guido Hulsmann, the banks must keep certain minimum amounts of equity and reserves. They must observe a great number of rules in granting credit. Their executives must have certain qualifications, and so on. Yet these stipulations trim the branches without attacking the root. They seek to curb certain known excesses that spring from moral hazard, but they do not eradicate moral hazard itself. As we have seen, moral hazard is implied in the very existence of paper money. Because a paper money producer can bail out virtually anybody, the citizen becomes reckless in their speculations. They count on him to bail them out, especially when many other people do the same thing. To fight such behavior effectively, one must abolish paper money. Regulations merely drive the reckless behavior into new channels. One might advocate the pragmatic stance of fighting moral hazard on an ad hoc basis wherever it shows up. Thus, one would regulate one industry after another until the entire economy is caught up in a web of micro-regulations. This would, of course, provide some sort of order, but it would be the order of a cemetery. Nobody could make any potentially reckless investment decisions anymore. Everything would have to follow rules set up by the legislature. In short, the only way to fight moral hazard without destroying its source, fiat inflation, is to subject the economy to a Soviet-style central plan. If we want to understand the source of banking instability, we might start there, instead of fooling ourselves into believing that another round of regulations, which, as surely as night follows day, will be gamed by the major players, will keep things stable. One of the reasons deregulation is viewed with so much skepticism, and even hostility, is that disasters of various kinds have been falsely, even laughably, blamed on deregulation. For Americans over a certain age, deregulation recalls the presidency of Ronald Reagan, and in particular the sad story of the Savings and Loan Institutions, S&Ls, in which 747 of those institutions failed at a cost of over $160 billion, most of which was paid by means of a federal government bailout. In the days before Reagan and his crazy deregulation spree, the story runs, everything worked fine. Then Reagan was elected, and he repealed all the laws. Society reverted to barbarism. Wolves ran free in the streets. What actually happened was rather less cartoonish. First, so-called deregulation of the S&Ls began under Jimmy Carter, not Reagan. I say so-called because, as with most measures trumpeted as deregulation, it was not really deregulation. All throughout the process of alleged deregulation, the S&L's deposits continued to be covered under government deposit insurance. Deregulation means the removal of government involvement and control. Does this sound like the removal of government involvement and control? To the contrary, it gave us the worst of both worlds. Now the government-guaranteed institution was permitted to take greater risks, while taxpayers remained on the hook for any losses. Not exactly the free market at work. Under the government-established rules, the S&Ls could charge 6% on 30-year mortgage loans and could offer depositors 3%. Since most depositors had nowhere else to go, they had to content themselves with a mere 3% return. But with the advent of the money market mutual fund, ordinary people suddenly had the chance to earn higher returns than S&Ls could pay and began pulling their money out of S&Ls in droves. Consequently, the S&Ls wanted permission to offer higher interest returns for depositors, so deregulation allowed them to do so. Had the original government requirements remained in place, the S&Ls would have gone under then and there. A consensus began to form that in order to save the S&Ls, their government-established loan and deposit interest rate requirements, as well as the kind of loans they could make, had to be modified in light of the impossible conditions under which these institutions were then being forced to operate. The S&Ls needed to be permitted to engage in riskier investments than 30-year mortgages at 6%. Notice, it's the free market's fault when the government modifies the government-established rules of a government-established institution while deposits continue to be guaranteed by the government. Got it? Maybe the S&Ls should have gone under in 1980. Perhaps they really did have an impossible business model. There's no non-arbitrary basis for deciding one way or the other, since the S&Ls were never genuinely subject to a market test. The government husbanded and cartelized the S&Ls and stood ready to bail them out after that. Yet, the string of failures continues to be blamed on, quote, deregulation and the market. More recently, in the financial crisis that first gripped the world in 2007 and 2008, we have seen yet another crisis falsely blamed on the market. We have already discussed the American case, but Iceland, which was particularly hard hit, is supposed to be the classic case of the free market run amok. Before it was over, the country's stock market had fallen 90%, all major banks had gone under, and a severe recession and a shortage of consumer goods bore down on the public. What remedy did our media class propose for Iceland? More regulation. What else? Without having to know the first thing about that country, readers will already have surmised what a closer look at free market Iceland will turn up. Government interventions, guarantees, and moral hazard all over the place, particularly in money and banking. And that is exactly what we find. Iceland, like the United States, experienced a gigantic housing bubble in the years leading up to the crash. And like the United States, the sources of that bubble were government and central bank, Iceland's Housing Finance Fund, whose debt enjoyed an explicit government guarantee, in contrast to the only implicit guarantees enjoyed in the United States by Fannie Mae and Freddie Mac. Artificially stimulated home purchases. Its low-interest loans were available to anyone without discrimination, and not just to those who fell below a certain income level. It was against this government-subsidized system that the, quote, private banks of Iceland had to compete. The predictable result was a race to the bottom in loan quality. Add to this a very loose monetary policy. The Bank of Iceland, a creature of the Icelandic government rather than the free market, increased the money supply, M1, by between 20 and 30% per year from 2002 to 2007. This monetary expansion added fuel to the housing bubble and gave rise to the structural distortions that Austrian business cycle theory describes. Unsustainable expansions in the aluminum, construction, and financial service industries were only the most obvious of these. The Bank of Iceland also offered Icelandic banks an explicit guarantee that it stood ready to roll over their short-term debt if a liquidity crisis should arise. With that guarantee in their pockets, banks engaged in what would ordinarily be the risky practice of maturity mismatching, borrowing short-term and consistently rolling over or renewing those loans in order to invest in long-term assets, pocketing the difference in interest rates between the two. Risk was practically removed by the Central Bank of Iceland, and thus the practice grew to levels it would never have reached on a free market. When liquidity began to dry up in 2008, the Icelandic banks were stuck, and the Bank of Iceland, promise or no, could not help them. It could create additional supplies of the krona, the domestic currency, but it couldn't create yen and other currencies to help the banks pay off their foreign liabilities. And the banks had been piling up liabilities in other currencies, particularly the Japanese yen. Loans denominated in yen must be paid back in yen. The credit-induced mania ended in disaster, which, in spite of the fingerprints of the government and the central bank all over it, was promptly blamed on the free market. The way the political and media establishments have addressed the claim that the housing bubble and resulting financial crisis might have been caused by something other than unregulated capitalism has been by pretending such a point of view does not exist. The academic world has been even worse. In 2009, Harvard University sponsored a conference called The Free Market Mindset, History, Psychology, and Consequences. Its purpose was to try to figure out why, since everyone knows the financial crisis amounted to a failure of the market economy, the stupid rubes continue to believe in it. The promotional literature for the conference opened with Alan Greenspan's testimony before Congress in 2009, when he claimed, in the face of all the arguments we have raised here, that there was a flaw in the free market he hadn't noticed before. The promotional material continued, quote, "If the current state of the U.S. economy makes clear that former Federal Reserve Chairman Alan Greenspan's faith in free markets was misplaced, the question remains, what was it about free markets that proved, and still continues to prove, so alluring to economists, scholars, and policymakers alike?" End quote. Because if there's one guiding principle behind the largest government in history, it's free markets. This conference, we were told, would bring together, quote, "leading scholars in law, economics, social psychology, and social cognition to present and discuss their research regarding the historical origins, psychological antecedents, and policy consequences of the free market mindset." So, instead of trying to understand the free market position itself, they prefer instead to study the twisted brains of those who advance it. In short, the conference was about this. Why do people still think the interaction of free individuals is a superior economic system to one directed by Harvard PhDs? Why do people cling to the idea that being herded into a collective run by the experts isn't the best way to live? Why won't the proles just shut up and go along with what their betters tell them? So, by assuming from the outset the very thing that needs to be proven, namely that the current state of the economy just occurred spontaneously as the result of wicked market forces, our betters relieve themselves of the need to consider their opponent's case. Their opponents do not have a case. They are deranged. I wonder if anyone at the conference asked questions like this. 1. When Alan Greenspan flooded the economy with newly created money and brought interest rates down to destructively low levels, thereby distorting entrepreneurial calculation, as well as consumers' home purchasing decisions, was that the fault of the free market? Do you think the Fed's creation of cheap credit out of thin air makes market participants more careful or less careful in how they allocate borrowed funds? 2. When long-term capital management was bailed out in 1998, and Alan Greenspan made clear that the Fed's assistant would be forthcoming were he unable to lean on his friends in the financial industry, was that a, quote, free market phenomenon? Do you think the Fed thereby encouraged more or less risk-taking among other major market actors? 3. The Financial Times spoke in 2000 in the wake of the dot-com boom of an increasing concern that the so-called Greenspan put was injecting into the economy, quote, a destructive tendency toward excessively risky investment supported by hopes that the Fed will help if things go bad. Financial consultant Michael Belkin added, quote, all the insane dot-com investment we've seen, all this destruction of capital, all the crazy excesses of the past few years wouldn't have happened without the easy credit accommodated by the Fed, end quote. Did the free market cause that? Do lending standards decline for no particular reason, or could this phenomenon have a teensy bit to do with A, government regulation aimed at increasing home ownership, and B, loose monetary policy by the Fed? Questions like these could go on and on. Not one, you can be certain, was raised that day at Harvard. Now, if you really wanted to sponsor an event whose purpose was to try and understand why people continue to believe things that have been falsified by reality, you do much better to hold a conference on socialism or an economist, John Maynard Keynes, and his school. It would be fascinating to learn the psychological motivation behind the persistence of Keynesian economics, whose popular version is a non-falsifiable ersatz religion. Is Japan's economy still suffering? Why, that's because Japan didn't spend enough, even though it spent so much that it became the most indebted country in the developed world. Have people spent so much that they're now burdened with debt they can't possibly repay? Then we need more spending. But don't worry, we'll repay it when the economy turns around, just as we always have in the past. Is the economy a distorted mess after an artificial boom? Then, instead of letting the economy restructure itself along sustainable lines, let's instead stimulate the system just as it is, with the goal of bringing about more consumption, more labor employed, and higher income, without bothering to disaggregate any of these things and deciding what kinds of labor need to go where, what kinds of consumption are sustainable, and what are figments of the bubble economy, or how the capital structure needs to be reassembled in order to cater to genuine consumer demand. People who believe in the market economy support a social order in which free individuals make voluntary contracts with each other, and no one can initiate physical force against anyone else. Is that vision so obviously unattractive that we have to refer its supporters for psychological evaluation? We might instead wonder about the psychological condition of those who would denounce such a system. Might they be motivated, for all their noble talk, by nothing but base envy of those with more material wealth than they, or by a pathological desire to dominate other people? Maybe that will be covered at next year's conference. For a full list of sources used in this chapter, 24 in all, download this free ebook at deregulationmyths.com. Chapter 2. The Role of Government Housing Policy in the Financial Crisis. This chapter, featuring Peter J. Wallison of the American Enterprise Institute, is drawn from episode 561 of The Tom Woods Show, December 24th, 2015. A quick note from Libranaut. In Tom's ebook, Chapter 2 pulls from episode 561, and Chapter 4 pulls from 561 and 638. This audiobook will present episode 561 as Chapter 2, and episode 638 as Chapter 4. To view Tom's ebook with full fidelity, download it for free at deregulationmyths.com.
But right now, it's my pleasure to welcome to the show Peter J. Wallison, who is a lawyer and the Arthur F. Burns Fellow in Financial Policy Studies at the American Enterprise Institute. He's the author of numerous books, but we're going to be talking today about his book, Hidden in Plain Sight, which came out early this year. Hidden in Plain Sight, What Really Caused the World's Worst Financial Crisis and Why It Could Happen Again. Peter Wallison is a frequent contributor to the op-ed pages of the New York Times, the Wall Street Journal, and the Financial Times. He holds his undergraduate degree from Harvard and his law degree from Harvard Law School. I'll be linking to his AEI page at tomwoods.com/561, as well as to this important book, which very helpfully supplements my book Meltdown from 2009, which focused quite a bit of attention on Federal Reserve policy. But of course, that's not the whole story, and Meltdown didn't claim that it was. There was a lot of this material in Meltdown as well. But the point is, when the Fed creates all this additional money, where does it go? And why was so much of it going into housing? And that's really what Peter Wallison's book will help you answer. Why would all this money be attracted to housing? Well, because housing was made artificially attractive as compared to a lot of other things you might spend your money on. So let's turn right now to Peter J. Wallison. Peter, thanks for being here today.
Good to be here, Tom. Thanks for calling.
I just told people about Hidden in Plain Sight. Very important book. It It's very much in line, as we were saying before we went on, with some of the material that I've written, and it addresses a lot of the common arguments that we hear about the financial crisis, the housing bust, and what really caused it. I want to start off with asking you about a couple of explanations that have been given for the financial crisis and the housing bust that are just not true, but that have seeped into the consciousness of the public to the point where it's hard to dislodge them. The key one is people were being sold mortgage packages that they just didn't understand. They were being scammed by people, by bankers who were tricking them into mortgages that they couldn't afford. And the poor public were put upon by these predatory lenders, and of course it all came to this bad result. What's wrong with that explanation?
Well, of course, that happened in some cases, probably a limited number of cases. I was on the Financial Crisis Inquiry Commission, and one of the things I asked is that, there's been a lot of talk about predatory lending causing this problem. Let's have some numbers on this. Why don't you find out how much of these loans were predatory? And of course, they couldn't find out. The answer really is that there was much more predatory borrowing going on than predatory lending. More people were taking out loans that they knew they couldn't afford because they were so cheap. These mortgages were being offered so inexpensively to people that they took them out, even though when the mortgages reset, so they were going to become more expensive, they couldn't pay them. They hoped that by the time the mortgages reset, they would be able to pay them, but by that time there was a financial crisis. All mortgages had fallen in value. Homes had fallen in value. They couldn't refinance the mortgages, and they defaulted. So I think the real answer is that there was much more predatory borrowing going on than predatory lending in the financial crisis.
All right, that's an interesting way to put it. Now, I also want to ask about, from the investor side, we hear that investors were dealing with these opaque financial instruments, and they couldn't really know what was in them. And because these instruments were being created, this just goes to show that the market economy yields you crazy investment decisions on the basis of very little knowledge about financial packages and instruments that people don't know anything about, that are very complicated, and that can easily blow up. Is there anything to that?
No, actually, that's completely false. And the reason we know that is that Fannie Mae and Freddie Mac bought the same kinds of instruments. Fannie Mae and Freddie Mac, of course, are the two major government-backed housing companies, mortgage companies, and they were very large financial institutions and had been doing this for years and years, buying mortgages from the private sector. That was their business. They bought the same mortgage-backed securities. They suffered the same losses, but they knew when they bought those securities exactly the mortgages that were in those securities. They were given tapes that they were able to read and see the quality or lack of quality of those mortgages, and they bought them anyway. And one of the reasons they did that is that housing prices were going up. In part, they probably thought those were good investments, but they also had to buy them because of the fact that they were required by the government to meet a quota of affordable housing loans that had been imposed on them in 1992 and got tighter and tighter until the mid to late 2000 years.
All right, let's follow up on that. One argument that critics of yours might make would be that these affordable housing requirements, it's true that Fannie and Freddie had to comply with them, and they may have played some role, but people like you, they'll say, have wildly exaggerated the role that they played, and they'll say there were totally private lenders who were not under nearly this much pressure to engage in affordable housing, and yet they made these crazy housing loans as well. Now, one thing that you can come back with is, well, the Community Reinvestment Act existed, and your application for a merger with another bank or activity of this sort will be evaluated according to how well you live up to the affordable housing standards. But that doesn't seem like it's an overwhelming amount of pressure on banks to make these loans. So how would you answer that? Like Countrywide, for example, what kind of pressures were on them for them to be so heavily involved in these mortgages?
Well, the reason Countrywide was doing it is the reason a lot of other banks were engaged in this, and that is they had a ready customer in Fannie Mae and Freddie Mac. By 2008, more than half of all mortgages in the United States were subprime or otherwise risky mortgages. Of those, that was actually 31 million mortgages, of those, 76% were on the books of government agencies, principally Fannie Mae and Freddie Mac. So Countrywide would make these mortgages because they knew that they could sell them to Fannie and Freddie. And in fact, Countrywide, for 8 years, was either the top or the second largest seller to Fannie Mae and Freddie Mac. The government was creating the demand for these mortgages. And so banks and others were making the mortgages because they knew that Fannie and Freddie would buy them. Now, there's another factor here, too, and that is that because Fannie and Freddie reduced their underwriting standards in order to take these poor quality mortgages to comply with the affordable housing goals, that built an enormous bubble, a housing bubble between 1997 and 2007. Housing prices went up an unprecedented amount, about 10% a year for several of those years. As housing prices went up, many private lenders thought this was a good investment. We could make money if we made these mortgages, even if we made these mortgages to people who were not quality borrowers, because by the next year, the house would be worth 10% more, and so our risk would be substantially reduced on some of these loans. But the reason there was this bubble was that Fannie and Freddie had reduced underwriting standards. They had formerly only made prime loans. That was up until the affordable housing goals were imposed on them. They had only made prime loans, but after the affordable housing goals were imposed on them, they started to reduce their underwriting standards. And you can see how you could get a bubble from that, because let's assume that you had $10,000 in order to buy a house as a down payment. If the down payment is 10%, then you can buy a $100,000 house. But if Fannie and Freddie said they will now accept 5% as a down payment, you could then buy a $200,000 house. Under those circumstances, of course, there was much more money chasing many houses, and that caused this gigantic bubble over time. So the bubble fooled the private sector to some extent. That's why many of them bought those mortgages. But the engine of this whole system was the government, particularly Fannie Mae and Freddie Mac, buying these mortgages in order to comply with the affordable housing goals.
It's funny that in the years that followed, the government and its apologists tried to claim that, of course, it had nothing to do with us. There's no way we could have caused something like this. But at the time and leading up to it, they were all too happy to take the credit for the increase in home ownership. And they said it's because of our policies. And in fact, Andrew Cuomo, after there was some famous discrimination case that had been settled against a bank, he said, now it's true that in the future, to meet our affordable housing and our fair housing standards, there will be more non-performing mortgages on these portfolios, but that's just the way it is. So he came right out and admitted that. Alan Greenspan, years later, of course, admitted that, yes, of course, there were going to be more risky mortgages made, but we felt like that was a good trade-off to have in exchange for a higher home ownership rate. So these people admitted it at the time, and then when it happens, they all pretend to scratch their heads like they have no idea what went on.
Yeah, isn't that amazing? Actually, the only person involved in this whole process who ever said anything in the way of an apology for having these policies was George W. Bush, who in his autobiography said, and this is, absolutely true. He said, I was very happy to see the increase in home ownership that was going on. What I didn't realize is all of the risks that we were creating for the economy. And that's the correct story in a sentence.
Well, I have to say, I'm not a big George W. Bush fan, but that's about the most significant admission of ignorance or wrongdoing that I pretty much ever heard from any president. Normally, it's just you circle the wagons and you defend yourself, and then that's it.
That's right.
But that's
right. You won't hear any such confession from anyone else who is lower down in the government who was actually making these decisions. They have never apologized for what they did or admitted. God knows the left has been taking the position that any statement about the affordable housing goals is completely wrong. But in fact, that is the answer. The affordable housing goals forced on Fannie Mae and Freddie Mac in 1992 and continued until 2008 created the financial crisis. That's what the book is about.
But isn't the whole point of these affordable housing requirements, the whole point is to make banks extend loans that they wouldn't have made otherwise? Why wouldn't they have made them otherwise? Because they're bad loans. So, it seems to me the logic of the thing is so obvious. That's why they want these regulations, is to make the banks do things they don't want to do. Why didn't they want to do them? Because they were stupid decisions.
Exactly. Well, the book contains a lot of the history of all of this, and just before 1992, there were community activists. The Democrats were in control of. I don't want to make this into a partisan matter because this occurred under both Democratic and Republican administrations. But in 1992, the Democrats were in charge of Congress, and the community activists were going to them and saying, home ownership in the United States has not increased for 30 years. It's still around 64%. And the reason is that these two big government-backed institutions, Fannie Mae and Freddie Mac, are imposing too difficult underwriting standards. They're requiring prime loans, and a lot of low-income people cannot buy homes because of that. That is what stimulated the adoption in 1992 of these affordable housing goals. It was to extend credit to people who didn't have good credit because they were low income and they couldn't afford, they couldn't afford mortgages, they couldn't afford down payments on mortgages, and by and large, they didn't have good credit records. That is why the affordable housing goals were imposed on Fannie Mae and Freddie Mac. That was the major mistake. If you wanted to help low-income people, you should have done it in a different way, perhaps some kind of government subsidy directly to those people where the government would take the losses. But instead, what's happened is they created this tremendous system in which banks and others were selling these terrible mortgages to Fannie and Freddie, who were delighted to get them in order to meet Fannie Mae and in order to meet the affordable housing goals. And the machine that was created resulted in the financial crisis.
How do you respond to the common argument that you are blaming this tremendous financial crisis on poor, vulnerable minorities, when the fact is it was rich white guys in investment banks spinning out crazy investment products who are to blame, and they're laughing all the way to the bank? That's what we hear all the time. The answer to that is that the government that created the demand for those loans by insisting that Fannie and Freddie buy them. Now, the whole purpose of that was to enable more loans to be made to people of low income who are otherwise not able to buy homes. And so the answer is that the actually worked. More people who were of low income were able to buy homes because of this system. But the trouble is that able to buy these homes, they created a huge bubble as a result of all of the money that was being poured into the financial system, and when that into the home ownership system, and when that happened, we got this gigantic bubble. Many more mortgages were made that shouldn't have been made as a result of the view that it was not risky to make these very terrible mortgages because home prices were going up. And the result of all of that, unfortunately, was a collapse in 2008 and a financial crisis. You write in the book about the Financial Crisis Inquiry Commission. Can you tell us what that was and what your role in it was and what the result was?
I was a member of the Financial Crisis Inquiry Commission right after the financial crisis occurred. Congress voted to set up to tell the American people and the president and Congress, of course, why we had a financial crisis. And the commission operated for about a year and a half in order to investigate the financial crisis and report on it. Unfortunately, the way it was set up, there were 6 Democrats and 4 Republicans on the commission. I was one of the Republicans. And the Democrats were dead set on demonstrating that this was a fault of the private sector, that the government was not involved at all. They wouldn't accept any arguments about the role of Fannie Mae and Freddie Mac or the role of the affordable housing goals, and produced a report that I think was simply a basis for providing the new excessive regulation that came out from Congress in the form of the Dodd-Frank Act in 2010. So this, unfortunately, was a system that was set up for the purpose, inevitably, of demonstrating that it was the private sector that had created the problem and leaving the government untouched, the government uncriticized for its role in this whole process.
What's wrong with Dodd-Frank in your view?
Well, I think Dodd-Frank is what is responsible for the very, very slow recovery we have had from the financial crisis.
Wow, okay, that's a strong claim.
Oh, there's absolutely no question on that. This recovery is the slowest we have ever had compared to all other recoveries from recessions in the past or financial crises in the past. And the only thing that is different about this situation from what occurred in the past is simply the enactment of the Dodd-Frank Act, which has suppressed the financial system to such an extent that it has been very difficult for small business in particular to borrow money. And without small business, we don't have the engine that usually gets our economy going.
Wow, okay. Well, I knew it played some role, but what's the big deal about it? I mean, there have been a lot of regulations imposed on small business over the years, and one way or another, they surmount them.
Yeah, it's true, but this is really extraordinary. The Dodd-Frank Act is by far the most substantial regulatory law placed on the financial system since the New Deal. And it is much tougher than almost anything that was adopted in the New Deal, so that it has frozen our financial system in place, so that large banks as well as small banks are not able to operate as inexpensively as they did in the past. The regulations that have been imposed on them are very expensive, and in particular, for small banks, they now have to hire a lot of staff, lawyers and compliance officials and so forth, that they didn't have to hire before in order to operate under these new regulations. And when you do that, you have less money available to make loans to small business, and particularly the startup businesses that really get the economy moving at the lowest level.
I have to ask you a question from about maybe the first third or fourth of your book, because it comes up constantly when generally the left is looking for some kind of deregulation that occurred that must account for this, because their view is that the more market activity there is, the more chance for fraud and financial bubbles and whatever. So there must be something. If only the government had had more regulatory power and could have cracked some more skulls, we wouldn't have had this problem. And they always settle on, as you well know, the so-called partial repeal of Glass-Steagall. And I know you've written a couple of scholarly articles on this, and then that there's a brief treatment of it here in the book. And it's interesting to note that even the Washington Post had an interesting op-ed piece some years ago saying, look, everybody, quit blaming Glass-Steagall. This is a complete red herring. And I don't know if it was you or somebody else I read who said the only reason Glass-Steagall is even mentioned by anybody is that it's the only so-called deregulation that they can find that has anything whatsoever to do with any of this. Like at least is even in the ballpark of having anything to do with it.
Yeah, that's so true. And I think was the one who said that, and I've said it many, many times. We've had deregulation in our economy. Happily, over many years, we have deregulated transportation, we have deregulated securities, we have deregulated broadcasting. All of these things have given us much lower prices for all of those services and much better services, a lot more innovation as a result of that. The one thing we never deregulated was finance. Now, the only law that anyone on the left can point to that could have been seen as deregulation is the so-called Glass-Steagall Act, and that's why it gets mentioned all the time. The only thing that the Glass-Steagall Act did was to allow banks to be affiliated with companies that engage in underwriting and dealing in securities. It did not allow banks themselves to do that. The Glass-Steagall Act is still applicable to banks. They cannot engage in underwriting or dealing in securities, but they were allowed to affiliate with firms that do. And so by mentioning the Glass-Steagall Act, the people who are talking about it have a great advantage in that they can confuse a lot of people into believing there was some sort of major deregulation that caused this problem. But in fact, most of the people who talk about it don't even know what the Glass-Steagall Act did. And the simple way I talk about it is simply to say, if the Glass-Steagall Act had remained in effect exactly as it was before it was changed in 1999, we would have had exactly the same problem, because our problem in 2008 arose out of troubling low-quality mortgages in our financial system and had nothing to do with a deregulation, if you even call it that, of the banking system. The banks, the non-banks that banks were then able to affiliate with, all got into trouble because they bought low-quality mortgages and held those low-quality mortgages because they didn't realize that they were, in fact, low quality. If the banks had actually sold them all off, then the banks wouldn't have been in trouble at all. But they didn't. They held on to many of them because they believed they were actually good quality mortgages. And one of the reasons they believed that is that home values were going up 10% a year. And if that's happening, then a mortgage on a home is a pretty good investment.
What about the claim that because of some form of deregulation, these investment banks were able to be much more so-called highly leveraged than they'd been in the past? And this goes to show once again that deregulation leads to highly undesirable outcomes.
This had nothing to do with deregulation. Investment banks were never regulated. So there really wasn't any case for saying that deregulation caused it. The investment banks, organizations like Goldman Sachs and Morgan Stanley and even Merrill Lynch were never regulated. The only part of that whole business that was regulated were broker-dealers, which are only the people who buy and sell securities for customers. But the holding companies of these broker-dealers, like Goldman Sachs and Morgan Stanley and Merrill Lynch and so forth, were never regulated. So it's inaccurate to say that there was something in Glass-Steagall that deregulated them. There was absolutely nothing in Glass-Steagall that referred to them or in any other regulation. The problem was simply that the government had created, through its policies, this tremendous bubble that was larger than any housing finance bubble we have ever had in our history. And as housing prices grew about 10% a year, as I said, in the 2000s, people looked at this and said, well, gee, these are wonderful investments, these mortgages, because the next year a person would have a home that was worth 10% more. And so even if that person defaulted on the mortgage, we would probably be able to recover the value of the loan that was underlying that mortgage. That, of course, didn't happen. And the reason that there was a collapse the reason that we had a collapse in 2008 was because we came to a point where homes had become so expensive that people couldn't buy them anymore, and the whole machine stopped running. So people could no longer refinance their homes when they couldn't meet their mortgage obligations and began to default.
Peter, there is so much material in this book that's so great. I mean, it's doing an injustice to your book even to say we've only scratched the surface. We haven't even scratched the surface of this book, especially the last two chapters. Just the subheadings of these chapters. So chapter 13, chapter 13, interestingly enough, from bad to worse, and the subheading is how government blunders turned a mortgage meltdown into an investor panic and financial crisis. And then chapter 14, the false narrative and the future, why the failure to understand the causes of the crisis may lead to another. I can't urge people strongly enough to check this book out. We're going to link to it at tomwoods.com/561. It's hidden in plain sight what really caused the world's worst financial crisis, and why it could happen again. Of course, that's the key point. Hang on the line 1 second after we finish, because I want to ask you a quick question just privately. But Peter Wallison, we really appreciate your time and your very important work.
Thank you very much, Tom. It's really a pleasure to talk with you.
That was Peter J. Wallison on The Tom Woods Show. Show notes for this episode can be found at tomwoods.com for episode 561. Chapter 3. Did crazy financial instruments bring down the economy? This chapter, featuring Edward Stringham, president of the American Institute for Economic Research, Davis Professor of Economic Organizations and Innovation at Trinity College, and editor of the Journal of Private Enterprise, is drawn from episode 783 of The Tom Woods Show, November 15th, 2016.
But there are also some evergreen topics out there that I still want to talk about, and one of them is the financial crisis, because we still are living with the consequences of that ideologically, because most people got that wrong. Most people think deregulation caused the problem. Okay, I've gone over that in the past. You can dig out episodes on that from, in fact, we'll put on the show notes page, tomwoods.com/783. We'll put some episodes dealing with that. We're going to talk a little bit about that today, but I want to talk about what actually went on during the crisis, and was the crisis caused by the sorts of things people claim. When they're not claiming deregulation, they're claiming it was certain financial instruments that caused the problem. And I want to talk to Ed Stringham, who's been on the show in the past, because he has an article, a journal article that I'm going to link to also on the show notes page, and it's called "It's Not Me, It's You, The Functioning of Wall Street During the 2008 Economic Downturn." And Ed is really hitting at the heart of the conventional narrative of the financial crisis in this journal article. So you'll definitely want to read it. Ed is a professor of economics over at Trinity College in Hartford, Connecticut, and he is also the author of Private Governance, Creating Order in Economic and Social Life, published by Oxford University Press. Ed, welcome back to the show.
Hey, Tom. Thanks so much for having me.
Great to have you back. I just stumbled upon this paper of yours I just told people about. I'm linking to it on the show notes page, which is tomwoods.com/783, so people can read it for themselves. But it's about the crisis of 2008. And if you ask me, even though that's 8 years ago as we record this, you can't talk about this stuff too much, because people already, by and large, despite our best efforts, got the wrong message from that episode. And that means that in the future, they're going to do the wrong thing when the same kind of thing happens again. So we've got to get this thing straight. Let's start off by having you explain what the mainstream explanation of the events of 2008, or in particular the explanation of how certain financial instruments performed and so on. What's the mainstream account of that that you are then going to challenge in this paper?
Okay, thanks. Yeah, so the standard view is that Wall Street created the economic crisis, specifically advanced derivatives and advanced securities such as credit default swaps, mortgage-backed securities, collateralized debt obligations. So a lot of people look at the market, they look at Wall Street, and they say, financial innovation occurred. Then they look at problems that manifested in society, and they say, see, Wall Street created it. The market created it. So there's a lot of finger pointing done by politicians to look at the private sector, to look at financial intermediation, and to lay the blame on them rather than, and we'll get to this in a second, looking at themselves in the mirror and saying, did government have anything to do with this at all?
All right, you mentioned collateralized debt obligations and mortgage-backed securities. I bet some people know what mortgage-backed securities are, but I also bet a lot of people treat it the way I treated the conflict in Bosnia in the mid-1990s. I was in graduate school. I had no idea what was going on. And I figured someday I'll get around to figuring this all out. I bet a lot of people feel that way about these things. Can you explain what they are?
Sure, yeah. So even a lot of free market people, they haven't studied it. And then some of them say, something must be fishy going on. There must be some conspiracy with government. And I actually disagree with that whole narrative, which is really advanced by more like the Occupy Wall Street types, where these things are fake. They're some type of scam. I think they're legitimate financial innovations, and I'll talk about each of them. Mortgage-backed security is the simplest to think about in terms of similar to a mutual fund, where a mutual fund takes 100 companies, puts it together, and then says, you can buy this security, which is not going to have one stock in it, but it's going to have 100 stocks in it. A mortgage-backed security will take 100 loans and put them together and then sell them to an investor who then says, okay, you know what? If one of these loans defaults or 5 of them default, I still have 99 left, or I still have 95 left. So it's basically a way of allowing people to extend credit to someone who wants to borrow, or 100 people want to take out a mortgage, without requiring people to put all of their eggs in one basket. So this is just simply a way of diversifying risk. And we can talk about this in a few minutes. Just because people invest in a company or invest in a mutual fund, it's not a guarantee of success. And same thing with investments in mortgage-backed securities. If the loans that people are making are bad loans, then it's not a guarantee of success. But in and of itself, I think the invention of a mortgage-backed security is an amazing innovation. It expands the amount of loans available. It diversifies risk among many people. So that's the first one that's fairly straightforward, which I think is great. The next one we can talk about is credit default swaps. And this one is also talked about very negatively in the press. A lot of people call it the bet that blew up Wall Street. And Warren Buffett, other people refer to these things as weapons of mass destruction. And I think, too, here they're actually very unfairly maligned. And I think they are a brilliant market innovation. And they're not technically insurance, but let's just think about these things as insurance. So suppose I own a mortgage that I've lent money to someone, but I'm worried that this person might default. Or suppose I've lent money to a corporation in the terms of a bond or any other loan, and I'm worried that that corporation might default. Well, I have to assume that counterparty default risk for this loan that I've given out. Now, one way I can mitigate that risk is I could go to a third party, someone who's selling insurance, someone who's selling credit default swaps, that says, you know what, if this party defaults, do you think that you could insure this loan? And so that's a further step of mitigating risk. And now, basically, as you take out this insurance policy, you are now mitigating risk against the risk of default. Now, a further step that people can do, you still have to assume that your insurance company, or in this case, the writer of the credit default swap, is going to pay. What if you have a policy and the insurance company says, oh, you know what? I don't have any money. And so people actually would take out insurance against the insurance company. So that is adding another level of protection. And so in this market, you had various levels of protection. In many cases, people would require these writers of insurance, the writers of the credit default swap, to put collateral aside to say, in the event of default, we will pay you back. And we've even put this money in an entity which is already there. So you are assured that you're going to get payment. So I think all of this is amazing. It's just like the insurance market. Now, given that there's insurance, it doesn't mean insurance is going to eliminate disease. It doesn't mean insurance is going to eliminate storms or floods or any other thing. And what happened in the market was a lot of the underlying securities turned out worse than people had predicted. Some of these mortgages turned out to be less safe than people predicted. And in these cases, people actually had to go to the sellers of the credit default swaps to say, would you pay me? But that's not a failure of the insurance market. It's just an existence of underlying problems in the economy. I'm going to mention a huge set of credit default swaps which functioned in an amazing way. So Fannie Mae and Freddie Mac were nationalized, and in the contracts for these credit default swaps, it said that would count as a credit event. So anytime somebody owns bonds by Fannie Mae or Freddie Mac, they're then entitled to this insurance. Well, it turns out there's trillions of dollars of these contracts with this reference. And people say, well, what are we going to do? How are we going to, have this huge payouts? Well, it turns out there's a private association called ISDA, the International Swaps and Derivatives Association. And they basically figure out the value of the loans in default. They then figure out how much you're owed. So if your bond is supposed to be worth 100 cents, it's only worth 80 cents. Well, now you're owed 20 cents. So they had this netting process and this huge amount of payment, and it all worked quite smoothly. So a lot of these things that people say, oh, it didn't work, it blew up, I actually argue it made problems a lot less worse than they otherwise would have been.
Well, I think you're right about the mortgage-backed security thing. The problem doesn't seem to have been with the instruments themselves so much as it was with the ratings. If people are told that they're AAA rated, well, then they're going to have a certain assessment of the risk involved. But there was such a systemic overestimation of the value of these things that it seems hard to exonerate the private sector of a major oversight or miscalculation. So how do you answer that?
I'm actually even going to slightly disagree with you here, Tom.
Oh, please do.
Yeah. So I do agree that investors misestimated future profitability of certain instruments. And so part of market is and part of any market, including government-controlled markets or even central planning, is we don't know the future with certainty. So that's just a fact of the world under any imaginable circumstance. When you go back in the olden days when you had small credit union style loans for mortgages, even then the people cannot predict the future with 100% accuracy. So sometimes they'll say, oh, well, John Smith looked like a good risk at the time, but I didn't realize he was going to lose his job. Or it turns out that a lot of the farms in the town go belly up, and people can misestimate risk. And so that's just a fact of the world. In terms of the rating agencies, these rating agencies didn't do a perfect job. So they would say, okay, this one is AAA and that one's fairly likely to pay back. This one is rated lower, and that's less likely to pay back. And it turns out they were a little bit too optimistic. However, I'm going to say that they largely were not wildly off track. So if you look at the loans that were more likely to be in default, it were the subprime rated loans, the subprime rated mortgage-backed securities, collateralized debt obligations, which we can chat about in a little bit if you want to. But the ones where you had AAA rated mortgages, there were not that much defaults in terms of the economy. They were much more reliable than the subprime ones. So the people who invested in subprime loans knew what they were getting into. They knew that these were high risk loans. That's why they had higher interest rate. But if you look at the rates for AAA rated mortgages, they were actually pretty good. So I've got a statistic here. In any given quarter, banks' foreclosure starts for prime fixed rates mortgages comprised only 1% of loans. If you look at prime adjustable rate mortgages, which are more risky, those are 2% of loans. And then once you start going to subprime mortgages, it goes up to 3%. And then when you get to subprime adjustable, it's like way higher. Okay, so the mortgages that were rated to be more safe actually were more safe. So it's not perfect, but just because things turn out a little bit less good than expected, it doesn't mean the market has failed.
There are a lot of objections. I want to talk about credit default swaps for a minute because I'm liable to forget, and this is a key thing. I'll kick myself if I don't ask you. I want to talk about the alleged cascade of failures that can be caused by this by the existence of credit default swaps. All right, let me just read you one sentence here. This is just from an article from 2008. The over-the-counter credit default swaps market has drawn the world's major financial institutions and others into a tangled web of interconnections where the failure of any one institution might jeopardize the entire financial system. This was what we heard throughout the period of the financial crisis, that we have institutions that are too big to fail, or that there could be systemic risk. There could be a kind of poison where one failure leads to another failure, which leads to another failure. And they point to credit default swaps as being at the heart of this looming risk over the whole system. What's the logic of that, and do you think there's anything to that case at all?
Well, if you look at The Big Short, it's kind of like part conspiracy theory type of book, and then also the movie. I actually like the movie, even though I think it really just misunderstands the financial instruments it's talking about. But at one point in the movie, they have this, I forget what the game is, one of these tower puzzles. And if you take the things out from the bottom, every other piece collapses above it. And that's how they portray these things. And it's certainly possible that you could arrange a financial instrument that way. But it turns out they designed them in probably exactly the opposite way. So you have basically different, in terms of, if we can talk about a collateralized debt obligations, these are basically combinations of these other instruments we're talking about, like mortgage-backed securities, and they would prioritize the income streams. And so there would be one group, the AAA rated tranche or slice, we might call it, which was basically guaranteed payment first. And then below that, there was someone else guaranteed payment second. And then at the bottom was, actually we should say at the top, is the people are called the first loss tranche. And so the people who assume the risk, the most risk, are the people say, you know what, if there's any problems, we agree to assume the losses first. And it's only at the very, very end do the safest tranches assume those losses. So that's actually quite the opposite of this description you're talking about. I know the quote is about credit default swaps, and I'll get to that in 1 second. But a lot of these things were designed in such a way to actually mitigate these problems. To get to the example of credit default swaps, the prudent firms, and I think Goldman Sachs, there's a lot of good reasons to criticize them for certain things they do with government, but I will praise them for the good things they did here. They were very prudent in terms of buying credit default swaps from many firms, including AIG, which historically was just a traditional insurance company that started selling these credit default swaps, the equivalent of insurance. And they not only bought some from AIG, but they made sure they didn't put all of their eggs in one basket. So they bought credit default swaps from multiple companies. So they didn't have too much exposure to AIG or any one other firm. They also required a huge amount of collateral. I think, say, of the $10 billion in credit default swaps they had insured by AIG, they had required AIG to put aside $7.5 billion in collateral. So even if AIG had gone bankrupt, which it didn't, the firms like Goldman Sachs would have been in an okay situation. They also had bought insurance, the equivalent of insurance, against AIG in case AIG fell. So the idea that firms' fates are interconnected, there's some truth to that. I totally get that and agree with that. But proper financial risk management means not putting too many of your eggs in one basket. If you are worried that AIG is not going to be able to pay your insurance, you can require collateral. In many cases, firms waived the collateral requirements as, AIG, you're good for it. You've got a AAA rating. Don't worry about it. But those were risks that people were willing to assume. So I just totally reject this whole notion that it's like a house of cards. You pull out the bottom card and then everything collapses.
Well, let me read you a passage from Peter Wallison over at AEI, who's really pretty good on this stuff. And just get your comment. He writes, just talking about the specific, not an abstract thought, but a specific case of what actually happened. He says, even Lehman's credit default swap obligations and the credit default swaps written specifically on Lehman by others did not cause any substantial disruption in the CDS market when Lehman collapsed. Within a month after the bankruptcy, all of the CDSs specifically written on Lehman were settled through the exchange of approximately $6 billion among hundreds of counterparties. And while Lehman had over 900,000 derivatives contracts outstanding at the time it filed for bankruptcy, these did not give rise to any known insolvency among those of its counterparties that were protected by a Lehman CDS. In cases where Lehman's derivatives counterparties suffered losses, the counterparties filed appropriate claims in the Lehman bankruptcy proceeding, which are being adjudicated in the ordinary course. In other words, Lehman, a larger firm than Bear Stearns, which was bailed out, and one that had more interconnections, had no significant effect in dragging down its counterparties. If Lehman's interconnections did not drag down its counterparties, Bear's certainly would not have done so. I assume you agree with that passage?
Oh, it's brilliant. I mean, it's really amazing if you think about the levels of complexity of these things. And, you mentioned hundreds of counterparties, so many different people involved. How are you going to, net these things? And in the olden days, we hear these stories of like, okay, there's going to be a run on the bank, and the first people are going to get these things first, and then that's going to cause everybody to go in. And I'm sure there was examples of this not working out for many people. But in this market, if they can wind these things down in such an orderly fashion, when you have a group like ISDA overseeing the process to make sure that it's orderly, to say, okay, you know what, we're going to figure out who owes what, and we're going to net these things. And then once we figure out the value of who owes what, then we can, ask people who are involved with the system to start doing payouts. So within this market, you can make a contract over an exchange. That's one option. Basically, you're dealing with a clearinghouse like this Chicago Mercantile Exchange. And in those cases, exchanges are very good at managing counterparty default risk, making sure people get paid what they are owed. But miraculously, even with contracts which are made not over an exchange, which are called over the contract contracts, so just bilateral between two people, even though you've got this very complicated network of those things, the fact that things worked nearly as well as it did in this Lehman example, I think we should be all jumping up and down and celebrating Wall Street and having like a parade for Wall Street.
Oh, that's not a very popular position to take, Ed Stringham. Just thought I'd let you know that. Well, what about
I'm the official anti-spokesman for the I'm the anti-Occupy Wall Street movement.
Yeah, there you go. There you go. Well, in the wake of the crisis, of course, people were scrambling around, the usual sort of people were scrambling around trying to figure out how to regulate the system better so as to prevent this type of crisis in the future. And it's your contention that, and I know this is a shock to a lot of people listening, that regulations sometimes can do more harm than good. So Can you elaborate on that? Now, I'm going to be talking to Peter Wallison. He wrote a book on Dodd-Frank, by the way. It's a collection of his academic papers, but it's like 600 pages long on Dodd-Frank. So instead of, don't tell him I said it this way, but instead of having my listeners try to read 600 pages, I'm going to have him on 2 days from now and talk to him for half an hour. I think that should do it on that subject. So you don't have to go into too much detail on Dodd-Frank, but in general, the urge for more regulation in the wake of the crisis, what do you think the upshot of that was?
So Dodd-Frank right now is the stuff associated with it. It's not even completely finished being written. You've created tons of small regulatory sub-bodies who have to fill in the details. But at present, it's 25 times longer than War and Peace. And I just finished War and Peace, and it was the best. But imagine 25 of those, not written by Tolstoy, but written by random unelected bureaucrats. And imagine the amount of constraints that's going to put on the banking industry. And so it turns out that the regulations are extremely onerous. They're extremely costly. They are basically trying to micromanage the way that financial firms interact with each other. It's adding a tremendous amount of cost to the system. And unfortunately, I was predicting this was going to happen a long time ago, that actually even when they did the Sarbanes-Oxley Act, people said, oh, you know what? Enron, all we need to do is have this huge set of regulations called Sarbanes-Oxley, and then that will solve all problems moving forward. And I predicted, which is not a very hard prediction to do, that no matter how many regulations they add in Sarbanes-Oxley, it's not going to predict the next set of problems. And it turns out we have a next set of problems, and they said, the problem was we didn't have enough regulation. All we need to do is have more next time. And I can predict right now, this is the way I'm 100% sure on, there's going to be some problems in the future, whether it's government created or just a natural market change in prices. And people say, see, it's because we didn't have any regulations. We just need to have Dodd-Frank times 25. And so the more regulations you add to the economy, the less able banks are able to actually make choices based on assessment of risk, and letting different banks assess risk in the way that they think is most proper. Instead, you've got government mandating that banks assume risk in certain ways, value risk in certain ways, which, if anything, is going to increase systemic risk in the system when all banks are having to follow a certain set of government rules and regulations. And I think we could see this coming, unfortunately, where you've got politicians saying, you know what, we are going to rein in Wall Street. Well, when you have a bunch of bad news coming, the bad news, which I'm calling future Dodd-Frank, that itself is actually going to depress stock markets. That's going to depress financial markets when these people realize they're going to be hammered by a future set of bad regulations. That actually will go and be priced in to current financial market prices. So I actually think that the economic downturn was caused by multiple factors, set off in large part by monetary factors, which one of my favorite books, it's called Meltdown by Tom Woods.
How about that? Yeah.
And then you add on top of that these, prospect of very harmful regulations, then it's no wonder that financial markets are going to get hammered, where it's like, all right, government destabilized us to begin with, and now we can't actually, start sorting things out in a reasonable way. We've got to be dealing with tons and tons of onerous regulations. That's going to actually bring down markets, not help them.
What would you say then to somebody who says, all right, Mr. Smart Guy, is your approach then to say that we don't need any regulation of Wall Street whatsoever?
Yeah, so historically, I think the better solution than government regulation is private regulation, which I will call private governance, private rules and regulations that come through private entities, through things like the New York Stock Exchange, which historically was, it still does a lot of private self-regulation, but had a much greater role before the creation of the Securities and Exchange Commission. It had listing requirements, it had disclosure requirements, it had membership requirements for brokers, traders, all that stuff. NASDAQ was a competing self-regulatory organization. Today we have the New York Mercantile Exchange, Chicago Mercantile Exchange. And if you want to opt into a more regulated, more privately regulated market, you can. If you want to opt out to a more a less regulated market, so things like the pink sheets or any type of unlisted firm, you can. But the advantage of market regulation, of private governance, is you let the investor opt in. So I'll give you a cool example with the hedge fund industry. You've got basically a set of funds which are similar to mutual funds, but they don't have to follow most of the mutual fund rules. So it's basically completely unregulated market for the most part. And you need to figure out whether your money manager is doing what he's saying he is. And we see cases like, unfortunately, Ponzi schemes like Bernie Madoff, where he says, oh, you know what, everything's great. And then investors say, well, where's my money? He's like, trust me, don't worry about it. Well, most investors don't do that. Most investors who are investing in these, quote, unregulated markets demand private third-party certification, custodian services. So you've got a system of private regulation that's verifying whether there's money in that account. In many cases, the hedge fund manager doesn't even have control of the funds. Those funds might be sitting in an account of, JP Morgan, for example. And so your hedge fund manager might say, oh, I'm going to abscond with all this money, but he can't, because you've got a system of private rules and regulations to actually provide assurances to investors. So this is the alternative, is not no regulation, but private regulation, effective private regulations that makes markets work.
I happen to know a guy who has a book on how private regulations and private agreements can manage a whole lot of difficult topics, and he's known as...
It sounds amazing. Do you have any insight?
Yeah, I know a little something about it. It's called Private Governance, and it's by this guy, Ed Stringham, who, as it turns out, I found out today, Ed Stringham was a fan of one of my books. So can you take a minute, say a little something about private governance?
Thanks, Tom. I love you. I do love a Meltdown as well. But Private Governance is my book that came out with Oxford University Press. And I basically go throughout history and focus on some modern examples, but a lot of historical examples as well, and look at the emergence of the first stock markets in Amsterdam 400 years ago, England 300 years ago, New York 200 years ago. Most people have this basically fictional belief that you need government to create the rules of the market. You need government to come in and say, here's how we're going to enforce contracts. And only after government creates the rules of the game, only after government creates the framework, will you see markets emerge. Well, it turns out that is not the case at all. Markets emerge in what we might call a spontaneous way. There's individual actors making choices at all stages of the game, but it's not being planned by the government, it's being planned by various private parties. And you can actually read what they're doing, the challenges that they face. And a lot of them said at the time, they said, you know what? Government rules are inadequate to deal with these complex markets. So we're going to create a system of private rules to deal with defaulters. We're going to create a system of private rules to deal with fraud and try and protect people from bad actions. And this is not just a small set of markets that happened for, a year or two. This happened for hundreds of years. Government wasn't enforcing contracts in the early stock markets. So instead, we had private rules and regulations, private governance, creating modern society, creating modern capitalism without the hand of the Dodd-Franks or the Elizabeth Warrens of the day.
Well, the book is Private Governance. What's the subtitle?
Creating Order in Economic and Social Life.
That is awesome. All right, so that's also linked at tomwoods.com/783. So that book and the paper we've been discussing are there, so you can get more detail on these topics. But I'm glad we hit on this because I know I've kind of indirectly covered this stuff in the past, probably not as systematically as we did today. So thanks for doing that, and we got to talk to you again soon.
Tom, thanks so much. Really enjoy it.
That was Edward Stringham on The Tom Woods Show. Show notes for this episode can be found at tomwoods.com for episode 783. Chapter 4. Did deregulation cause the financial crisis? This chapter, featuring Peter J. Wallison of the American Enterprise Institute, is drawn from episode 638 of The Tom Woods Show. April 12th, 2016.
Hi, everybody. Tom Woods here. We're talking about deregulation and the financial crisis because we all know deregulation caused the financial crisis. That's what everybody tells you. But is that really so? Now, of course, I've written on this and spoken on this, a little bit of this in my book Meltdown, much more on this subject in my 2011 book Rollback. But in particular, there are two acts of deregulation that are pointed to as the culprits in the financial crisis, and those are the Gramm-Leach-Bliley Act, or the so-called repeal, and they really mean the partial repeal of Glass-Steagall, and the Commodity Futures Modernization Act. And I want to talk about the extent to which these two things had anything whatsoever to do with the financial crisis. And joining me to do that is Peter J. Wallison, who's been on the program in the past. He is a lawyer and the Arthur F. Burns Fellow in Financial Policy Studies at the American Enterprise Institute. He was a dissenting member of the 2010 Financial Crisis Inquiry Commission because, of course, he had rather a different explanation for what had caused the financial crisis. And he also served as general counsel of the U.S. Treasury Department in the Reagan administration. Peter Wallison, welcome back to the show.
Great to be with you, Tom. Thanks for the invitation.
This is episode number 638. Better late than never that we're finally getting to this general subject. I've talked about deregulation and how it's a red herring when it comes to the financial crisis, but there are two particular things that get thrown at you when you try to say that. And I'm talking about the more informed people on the left. The others are just have some vague sense that there's some regulation that might have saved us and if we hadn't repealed it. So let's start off with this Gramm-Leach-Bliley Act and the partial repeal of Glass-Steagall. Tell us what Glass-Steagall was and what it was intended to do, and then let's talk about whether and to what extent it was actually repealed.
Glass-Steagall had two provisions. One said that a bank could not engage in underwriting or dealing in securities. That we're talking here about a commercial bank, an insured bank, could not underwrite or deal in securities. The other part of Glass-Steagall said a bank could not be affiliated with a company that engages in underwriting or dealing in securities. In 1999, the Gramm-Leach-Bliley Act repealed the second provision. That is, banks could then be affiliated with firms that engage in underwriting and dealing in securities, but the first part of Glass-Steagall is still applicable to banks. They cannot underwrite and deal in securities.
All right, now let's dumb this down a bit. I don't mean my audience is dumb, but this is not a layman's discussion, really, so I want to make sure that everybody's following along. What does it mean to deal in securities?
What it means is that you buy a portfolio of securities and you hold them for the purpose of selling them or buying them. It's sort of like thinking about it as a dealer in any product, let's say an iPhone. And if you're selling iPhones, you also buy iPhones for resale. That is dealing in securities.
Okay, so in other words, if a bank is sitting on a mortgage-backed security, but it's just holding it, that's not dealing in it.
Right. If a bank is buying mortgage-backed securities, for the most part, they are buying those for investment, to hold them. And that's, in fact, what they did. But at times, banks can also decide, just like any dealer in any product, let's say Exxon dealing in oil, they can decide that they no longer want to hold the product for investment, and they sell it. That's also permitted. So banks can buy and sell securities, mortgage-backed securities, or other kinds of securities, debt securities of various other kinds, not equity securities, but debt securities. They can sell those securities at any time if they decide that they no longer want to hold them because the investment is not good.
So what we have then is that the primary thing that's repealed is the idea that you can't have a single holding company having a commercial bank and an investment bank. Is that right?
No, you are permitted to have a single holding company.
Yeah, that's what I mean. Yeah. So they repealed that. They repealed
that. And so you are now permitted, a single holding company can hold both a bank and a securities firm that underwrites and deals in securities. Yes.
Okay, so now let me read you this paragraph. It says, we got Bear Stearns, Lehman Brothers, and Merrill Lynch, three institutions at the heart of the crisis, were pure investment banks that had never crossed the old line into commercial banking. The same goes for Goldman Sachs, the infamous AIG, an insurance firm. New Century Financial, a real estate investment trust. No Glass-Steagall there. This is from the Washington Post, which is not known for being anti-regulation, but there's a column from the Post from several years ago saying if you're trying to look for a boogeyman, this one's just not going to work because it doesn't match up with the financial crisis we just endured. We did not have a problem with institutions, where we had a mingling of investment and commercial banking. That's not what happened.
That's entirely right. The whole Glass-Steagall issue is completely irrelevant to what happened in the financial crisis. And people have to really understand what happened in the financial crisis to understand why it is true. And that is everybody who got into trouble because they bought and held mortgage-backed securities or mortgages themselves. The issue of dealing and underwriting in securities was never a question in the financial crisis. AIG got into trouble by actually they insured mortgage-backed securities rather than actually holding them. Bear Stearns, Lehman Brothers, Goldman to some extent, all got into trouble because they invested in, held, in other words, mortgage-backed securities or mortgages.
So in other words, they were doing something they had always been allowed to do. There was no phantom regulation that was repealed that suddenly allowed them to do these things.
Exactly. In fact, that's a really good way to put it, Tom, because if Glass-Steagall had never been touched by the Gramm-Leach-Bliley Act in 1999, the financial crisis would have unfolded exactly the way it unfolded in 2008.
I get the sense, though, that some people who say what we need is a resurrection of Glass-Steagall, let's say we're talking about the more informed ones, their view might be, okay, you're right, it's not directly related to the financial crisis, but they seem to think there's some connection between the partial repeal and the rise of institutions that were too big to fail, that contributed to the creation of these gargantuan institutions. Is there anything to that?
No, because the ones that actually failed, there were three different kinds, three different institutions different kinds of institutions that failed. There were the AIGs, which was in fact an insurance holding company, but it also engaged in insuring, in effect, with this so-called credit default swap. It was also insuring mortgages. That's one kind. Another kind was an investment bank like a Goldman Sachs or a Lehman Brothers or a Bear Stearns. They got into trouble because they bought and held as investments mortgage-backed securities. And then there were commercial banks like Wachovia or WAMU, that is Washington Mutual, known as WAMU, or IndyMac, three different kinds of commercial banks. They also got into trouble by holding mortgage-backed securities or mortgages themselves. So what we learned from all of that is that it doesn't matter what kind of institution it was or what kinds of laws applied to the way they carried on their business, but the fact was that they got into trouble by investing in these very low-quality mortgages.
All right, so it all basically comes down to trying to figure out what the fundamental cause of the crisis was. And the cause of the crisis is quite mundane. It's that you have banks that extended mortgages that should not have been extended. That is really – and that's something that banks always had the power to do. They always had the power to make lousy mortgages.
Yes. Now, we're talking about Glass-Steagall, but if you want to know and I'm saying to you that Glass-Steagall had nothing to do with the financial crisis, and no restoration of Glass-Steagall would have prevented the financial crisis. So let's leave that aside, because in fact there was a cause for the financial crisis that no one is talking about, and especially people on the left are not talking about, because it was government housing policy that caused the financial crisis. And in fact, I would argue that the whole Glass-Steagall idea was raised as kind of a smokescreen to prevent people from talking about the real problem, which was what the government did in housing policy.
I'm going to link on today's show notes page. We're on episode 638, so tomwoods.com/638. I'll link to our previous discussion where we really, you had some great information. We really went into that and explained and exposed it. You're right. I think, and I read an economist named Bill Woolsey said that the only reason he can think of, and it might have been Alan Meltzer, but one of them said the only reason they can think of that anybody would point to Graham Leach Bliley and the partial repeal of Glass-Steagall is that it's the only regulatory move and change of any kind that's even remotely connected to anything having to do with anything.
Actually, I said that, Tom. But maybe Alan Meltzer picked that up too. I haven't read all his stuff, but I've been arguing that from the begining.
Well, hold on a minute. Let me point something out before we went on. This actually confirms what I told you before we went on. I said. People have been wanting to know about this Glass-Steagall thing, and I want you to talk about it because everything I know I learned from you, including your funny lines, apparently.
Well, it is very, very frustrating because people who know better have been talking about this as though they understand it. A senator from Massachusetts by the name of Elizabeth Warren has been saying on radio programs that I've been on with her that Glass-Steagall was responsible for the financial crisis. Oh. But then later on, in candid discussions with other people, she has said, well, no, of course, it really had nothing to do with the financial crisis, but it's important to understand that it was deregulation of some kind. The important thing to understand about deregulation of some kind is that we've had a lot of deregulation, and it's been great for the United States. We have had deregulation in some parts of finance, like the elimination of regulated costs for trading securities. That's now all free market. We've had deregulation in communications. That has given us the internet and iPhones and so forth. We've had deregulation in transportation. The one area where we have not had any deregulation is in the regulation of banks. That has only gotten tighter and tighter over time, with the exception of Glass-Steagall. And that was not a deregulation of banks at all. It was a deregulation, if you want to call it that, of the companies that own banks. They could then own also firms that were engaged in underwriting and dealing in securities. So the left, and I'm sorry to say this and impugn their motives, but the left has been looking around for some kind of deregulation that could have caused the financial crisis, and they hit on the Glass-Steagall Act. And since no one else knew anything about it, and it's a complicated idea,
Right.
they've been pumping that idea now for years, and people have fallen for it. But in fact, it had nothing to do with the financial crisis, and the left, unfortunately, has to face the facts. And the facts are that government housing policy, as I made clear in my book, and you were kind enough to talk about my book at one time, as I made clear in the book, well, the financial crisis was caused by government housing policy, nothing more.
Remind us of the full title of that book.
Oh, it's called Hidden in Plain Sight, What Caused the World's Worst Financial Crisis and Why It Can Happen Again.
Yes,
Hidden
that's
in
right.
Plain Sight.
Okay, so that's also going to be linked at tomwoods.com/638. You know what's funny about the whole Bogeyman story of Glass-Steagall is that the same people who push that also tell us that in Canada they weathered the financial crisis better than we did here. Yet Canada had no Glass-Steagall in the first place, so they're contradicting themselves.
Yeah, of course they are. And you can't really compare Canada's banking system to our own banking system. Canadian banks have different powers, and, in fact, Canada did not have the government policies that created the very poor quality mortgages that suffused our financial system in the United States.
Let's switch now to the other thing. Now, this is something I don't know the first thing about. I know nothing about this. I am the last person in the world to be talking about this at all. There's when you get them on Glass-Steagall, then they come back with something that sounds even more complicated, the Commodity Futures Modernization Act of 2000. And I know you've written about this too. Tell me what that was and what's the deal? How is that connected to anything?
In the year 2000, this was during the Clinton administration, the person who was the chairman of the Commodity Futures Trading Commission said that she wanted to regulate credit default swaps. I'll get to what those are in a minute. The chairman of the Federal Reserve, the chairman of the banking committees in the House and Senate, the chairman of the Secretary of the Treasury at the time, Rubin, all said that would be a terrible idea. In addition, not only is it a terrible idea, but the idea that you are going to be regulating the credit default swap market is going to make that market very difficult to operate, because people are going to be afraid to get involved in the market if they think that the Commodity Futures Trading Commission is going to come in and impose various kinds of regulations, making their investments weak or troubling or bad. So they adopted in something called the Commodity Futures Modernization Act a rule that said the CFTC, the Commodity Futures Trading Commission, cannot regulate credit default swaps. That's what the Commodity Futures Modernization Act was about. There are other provisions in that act that did good things, but in this case they did a bad thing, according to the left, and that is they restricted regulation of the credit default swap market. Now, what are credit default swaps? Sounds very complex. They're not actually very complex. They are simply a kind of insurance product on a financial instrument. And you can buy protection for your financial instrument, its decline in value or its failure or whatever, by paying a premium to someone who will protect you. That's called that transaction is called a credit default swap. Again, same thing as we have been talking about Glass-Steagall. The same thing happened with credit default swaps, and that is, as soon as there was a problem in the market, various people, principally on the left, but also the government, and I will have to blame this in part on the the late part of the Bush administration began to say, well, this is particularly Henry Paulson, who was the Secretary of the Treasury at the time. Well, it was also the reason we had to bail out Bear Stearns is because these credit default swaps were going to make all of these companies fail. If one of them failed, it would drag down all of them because they're all interconnected through these credit default swaps. That idea was shown to be false when Lehman failed. Because when Lehman failed, no other firm got into trouble because of Lehman's failure. And Lehman was a big player in the credit default swap market. But the idea has lived on that it is necessary to regulate credit default swaps. And in the Dodd-Frank Act, there was a very strong set of regulations or power to make regulations that were given to the CFTC, the Commodity Futures Trading Commission, in order to regulate credit default swaps, and they have now been thoroughly regulated. That, to me, is not a good idea. It has not produced anything good, and it did not save us from, and will not in the future save us from anything bad.
Your mention of Dodd-Frank reminded me of something that I have to tell you. You know, you mentioned Dodd-Frank. Maybe your ears were burning today because we were recording. I have another podcast. I do this show every weekday, but I have a weekly show called Contra Krugman. We refute Paul Krugman every single week, a friend and I.
Well, that's
it's
easy.
great. Yeah, we got to get you on that show. Why should everybody else have all the fun? We had Dan Mitchell from Cato on today.
Great guy, Dan.
Oh, yeah, and I talked to him about, all right, we were talking about, Krugman had a column about how Obama's actually been a terrific president, and here are some of his accomplishments, and he gave financial reform as one of his accomplishments.
Yeah, right.
And I cited an article you wrote maybe 6 months ago connecting Dodd-Frank and the disproportionate burden it places on community banks, small institutions, and that's where small businesses, where a lot of the job growth was coming from, get their credit. And now suddenly we're not seeing job growth coming from small business anymore, and you connected the dots very effectively in that column.
Yes. Well, it is true. It is absolutely true that the reason that our economy has not recovered as smartly as it always recovers from steep recessions is because of the Dodd-Frank Act and the burden that it has placed not only on small banks, but also on the financial industry in general. Raised their costs tremendously, made them much more risk-averse than they had been before that. But the major problem with small business is coming from the burdens that have been placed principally on community banks by the Dodd-Frank Act and the behavior of the regulators after Dodd-Frank was adopted.
I'm looking at Amazon. You have a book called Bad History, Worse Policy, How a False Narrative About the Financial Crisis Led to the Dodd-Frank Act. And according to Amazon, this book is 552 pages. Is that right?
Yes, it is. But let me say this, and that is that this book is a series of essays that I wrote about Dodd-Frank before Dodd-Frank, before the book was published. But while it was under discussion, after it had been adopted, I wrote maybe 20 essays, long ones, and they're all collected in this book. So that's my contribution to the Dodd-Frank issue.
All right. Well, let me ask you this: would you be open someday to coming back and talking exclusively about Dodd-Frank to us?
Oh, of course. Oh, yes.
Yeah.
Absolutely.
Look. You write a book that length. I'm afraid you're tethered to that issue for a while.
Right. No, I'm happy to talk about. Of course, I'll talk about Dodd-Frank. I really do think it has been a catastrophe for this country, and one of the reasons that we have so many disaffected people in this country, because we have not had the economic growth that people are accustomed to since Obama came into office. And the principal reason for that, look, let's put it this way. There are only three major things that have happened in the financial world since Obama became president. One is the Fed cut interest rates down to virtually zero. There's Obamacare, and there is Dodd-Frank. Now, those first two Obamacare and the Fed cutting interest rates to nearly zero should stimulate the economy. Obamacare because it added so much more government money into a major sector of the economy, which of course is healthcare. But we haven't had any growth. We've had the slowest recovery ever since the 1960s. And why is that? It can only be one reason, and that is the Dodd-Frank Act. And so people have not seen an increase in their salaries, their compensation. In fact, many of them have seen a decrease. The economy is growing very slowly. We do not have the kind of economic growth that has always made people confident about the future. And as a result, we have a lot of people who are looking at this election as a way of stopping the terrible things that have happened over the last 8 years. And yet, it seems very unlikely that either of the candidates that are the front runners now will be able to do anything. One of them is, of course, just backing Obama's policies and promising to make them even worse for the economy. And the other doesn't actually seem to have a very good idea of how to handle the economy anyway.
But can I ask you just one more thing before I let you go? I'm
Sure.
sure we covered this in the last conversation, but every time I see, whether it's even Krugman's column that we were talking about on the show today and all that, anytime I see somebody like Krugman refer to the financial crisis, they always talk about predatory lending. So they think
Right.
they think that predatory lending could bring down. There could be so many loans that were made, for the express purpose of deceiving people, that brought the system down. What do you say to the claim that it was predatory lending on the part of institutions, that they wanted that they knew these people couldn't make the payments, but somehow they could make short-term profits that way?
Well, there are two things I'd like to say about that. First of all, I was a member of the Financial Crisis Inquiry Commission, the one that studied the crisis. I dissented from their view because I thought they came out with the wrong answer, part of which was that predatory lending occurred and was responsible. It does occur, of course. There are always bad actors in any business, and some predatory lending did occur. But all the time I was on the commission, I said, look, if you think predatory lending is an important factor, give me some data. Show me where it is, how much of it was there, who has calculated all of this. Otherwise, it's just a slogan. And for all the studying that the FCIC did of what led up to the financial crisis, they were never able to provide any data on predatory lending. I will not deny that it occurs. However, I don't think it was a major factor. What was a major factor was the vast reduction in mortgage underwriting standards that occurred between the middle of the 1990s and 2008, and that was because of the affordable housing goals that had been adopted by Congress and imposed on Fannie Mae and Freddie Mac, and that's what is detailed in my book. That's why we had the crisis. And you could call some of the loans that were made in that case predatory loans, but they were made because the government wanted those mortgages to be made. Let me give your listeners one fact that is very, very important when you talk about this issue, and that is in 2008, just before the financial crisis, there were 31 million subprime and other low-quality mortgages in the U.S. financial system. 76% of those mortgages were on the books of government agencies, principally Fannie Mae and Freddie Mac and the Federal Housing Administration. And that demonstrates one thing beyond question, and that is that the government created the demand for those mortgages.
Well, the book, that book is Hidden in Plain Sight, as we said, What Really Caused the World's Worst Financial Crisis and Why It Could Happen Again. So again, I'm going to link to that at tomwoods.com/638. And I'm looking at it right now on Amazon, and there's a hardcover edition that's dated 2015, and then I see a 2016. So is there a recent paperback?
Yeah, there's a new paperback out.
Oh, we should have done a whole episode for to push the new paperback.
Great.
Well,
yeah.
I'll link to the. I'll at least link to the paperback. Yeah, we got to give the book new life here.
Yeah, I believe you should. And look, it should have new life because it is still relevant to public policy in the United States. If we continue to believe that our financial crisis was caused by insufficient regulation, we're going to have more regulation, and that's what Hillary Clinton is talking about. If, on the other hand, we understand that government policies caused the financial crisis, then we look at it entirely differently, and we understand that regulation is a problem rather than a solution.
All right, we're going to leave it there. I'm really glad that we were able to cover this topic. Now I can hold my head up high that I have smashed the last myth that I need to related to the financial crisis. Unfortunately, there'll be more myths on all kinds of other topics coming at me in the headlines from now until I drop dead. But at least I've covered this one topic, and I appreciate your time, Peter Wallison. Thanks so much.
Thank you, Tom.
That was Peter J. Wallison on The Tom Woods Show. Show notes for this episode can be found at tomwoods.com for episode 638. That does it for Deregulation Bogeyman by Tom Woods. Remember to subscribe to The Tom Woods Show on iTunes or wherever you get podcasts to be the first to hear these episodes when they are released. If you found this audiobook valuable, consider visiting Libranaut.com to make a voluntary donation. Becoming a Libranaut patron will support this production and future projects like it. I highly recommend subscribing to Tom's newsletter. Although it's true that I generally hate newsletters, I remain subscribed to Tom's because of its extra content, discounts, and bonus material. It's worth the click, and you can unsubscribe anytime. Are you troubled by the left-leaning bias in universities? According to the Higher Education Research Institute, liberal to far-left professors outnumber conservative to far-right professors 5-1, and even outnumber moderate professors 2-1. Some have argued that it's easier to find a self-proclaimed Marxist than even a conservative on college faculties. A great way to combat this bias is Tom's Liberty Classroom. Liberty Classroom features college-level videos about economics and history that offer a competing viewpoint. Find out more at libertyclassroom.com. Deregulation Bogeyman is written by Tom Woods. This recording was done at libranaut.com. Music provided by Keys of the Moon. The song, The Epic Hero, is under a Creative Commons license. Thank you for listening.